have to compliment Hardman for quite a selection of different companies, and hope we're not going to disappoint as the last one, but tell you a bit about non-standard finance. So very much we do what it says on the tin. So as Keith said, we provide unsecured credit to the 10 to 12 million people who can't borrow from a high street bank. We were set up and listed in 2015 by a chap called John Van Cuffler, who ran Provident Financial for 23 years, 6 years as chief executive and 17 as chairman. And over that period, he delivered a 40-fold return for his investors. And so on the back of that, when he retired from Provident, he was thinking about what he was going to do next and just saw a major opportunity in this marketplace. So hopefully I can give you a bit more information about that. So just in terms of the scale of the opportunity, really the point here is that this is not a niche. This is a large marketplace. As I said, 10 to 12 million people in the United Kingdom cannot borrow from the bank where their salary or the money that they earn goes into. And really that comes from two sources. So why won't the banks lend to all these people? Firstly, people are on low pay or low income or variable income. So self-employed is a big potential source of demand, and we know that 15% of the workforce are self-employed. Or they're low paid. 18% of the workforce is 2/3 of the average, which is deemed to be low paid. So that's a big source of potential demand as well. Or they're credit impaired in some way. Something has gone wrong in their past. You know, you find you miss a credit card bill, you fail to pay your mobile phone, then you can find yourself, your credit score is low, the banks won't lend to you. Similarly, if you missed a council tax payment or are pursued through the courts, you get a county court judgment against you, that will stay on your credit file for 6 years. Last year, 1 million county court judgments are issued, and automatically that will mean you're scored out by the banks. They won't want to touch you, and you've got 14 million people who are using unauthorized overdrafts. So this is a large pool of people who are underserved. So that's the sort of demand side. Well, what about the supply side? And this is some data from LEK, and this is just the level of outstanding loans of unsecured and other credit to the non-standard market, so people who are not borrowing from high street banks. And you can see that post-financial crisis, in aggregate, there was a bit of a decline because a lot of the prime lenders who had businesses in the subprime space decided they wanted to exit, so they just ran off those loan books, and you can see the sort of decline here, and then gradually started to pick up. And there's a whole variety of different types of non-standard lending. You've got, mail order, you've got store cards, credit unions, and we sit in this other unsecured products. But even within that, there's probably around 11 different categories, and we're in 3 of them. And I'll just go into and describe each of those in a second. But before I do so, just a bit about us. So you've got the overview about who is non-standard finance. So we're a national player. We listed in 2015, we raised 100 million as a cash shell, and then went on the acquisition trail, and we've acquired 3 businesses and are now all over the country, serving probably over closer to 200,000 customers now, 140 offices, we've got around 900 staff, we've got 900 self-employed agents, which I'll come on to in a minute, and we've built a loan book of 336 million. This is at the half year. As I say, we're in 3 businesses, so we're the number 1 branch-based lending company in the UK to the credit impaired. We're the number 2 in the Guarantor loans business, so behind Amigo, which is the market leader. And we're the number 3 in home credit, behind Provident and Morses Club, which are 2 other listed groups. All of our businesses are fully authorised by the FCA. This is a highly regulated space, and we're listed on the main market. So a bit about each of our divisions. So as I say, we've got 3 businesses. So the first, our largest business, is in branch-based lending, everyday loans. We're the number 1 in the market. In fact, we're the only branch-based lender servicing the credit impaired in the UK. We bought that business in April 2016, and since we acquired it, we've pretty much doubled the loan book. And we've doubled the size of the network. When we acquired it, had 36 branches. It's now got 73. So we've grown it very aggressively, just under 70,000 customers. And typically the loan size between £1 and £15,000, anywhere from 12 to 18 months up to 5 years in length. And the APR ranging anywhere from around 24%, so that's pretty much the same as a credit card, but all the way up to someone who is deeply subprime with very thin credit file, no credit history. We might look to charge them an APR of up to 249%, but that would be typically for a very short-term small loan. And the customers here are really Joe average. So earning average income around £30,000, they're salaried, and that really is the typical customer for us. Second largest business is Guarantor Loans. As I said, we're the number 2 in the market, behind Amigo Loans, another large listed group. We've got a loan book of around 100 million now. When we acquired 2 businesses to generate the Guarantor Loans division, but on acquisition that was around 40 million loan book, and it's now over 100. So we've grown it very aggressively over quite a short time frame. At the half year, in the first half, we grew the loan book by 53%. Around 30,000 customers, and again, the loan size very similar. And for those of you who are not familiar with what a guarantor loan is, I mean, when I bought my first flat, my father acted as guarantor. That was the only way I could get the building society to lend me the money. This is formalising that product, that idea. If somebody wants to borrow money, by having a guarantor, they're able to borrow at a much lower APR than they would be able to if they were borrowing on their own. Again, a slightly lower level of income for this type of customer, and typically this is a younger person, might be someone got their first job, they need a car to get to work, they've got no credit history because maybe they maxed out their credit card at university or didn't pay their mobile phone bill, and by having an uncle, aunt, mum, dad act as the guarantor, they can get the loan that they need and get on the credit ladder. And lastly, the third business is in home credit. So this is a traditional doorstep lending business. This is an industry that's been going since 1880, and the agent goes to the house, the loan is made in the house, and the agent goes back typically weekly to collect what is a relatively small sum. The size of the loans are pretty small. You can see there between £100 and £1,000 typically, and the loans are very short. So anywhere from 24 to 63 weeks, but typically our biggest products are in the 33 and the 46-week products. Got around 90,000 customers, and again, we've got 900 agents who are going up garden paths every week, talking to their customers, lending and collecting. Quick snapshot of the first half-year results. So loan book was up 26% versus the first half of last year, as I said, to 336 million. Revenues are up 12%. Our operating profits are up 28%, so growing nicely. And earnings per share were up 13%. We are paying dividends. These are all half-year figures, and at the back of your packs, you can see I put the full-year numbers so that you've got a full-year representation. But just to show you the sort of dynamics of where we're at in the first half. We are, as I say, we're paying dividends, and we have a progressive dividend policy, and we're targeting around a 50% payout ratio. Just in a bit more detail about the performance of the business, just going through some of the key metrics. So in terms of the loan book, and here you can see in the chart, I've split the loan book growth out by the 3 businesses, and you can see that Everyday Loans, our branch-based lending business, is the bulk of the business. It really is the engine of growth. That grew 22% in the first half. Guarantor Loans is a relatively new segment for the group, and as I say, we're the number 2 player and have been able to grow that very strongly. It's a really popular product. Home credit is a very mature industry, and that's growing more slowly but still profitable, as I'll come on to show. In terms of revenue, follows quite a similar path to or a similar pattern to the loan book growth. Revenue in the home credit business, of course, is higher as a proportion relative to loan book because the loans are so short. we're getting those paid back much more quickly within a year. So revenue again, branch-based lending grew 22%, guarantor loans grew 40%. Home credit went back slightly. But in terms of operating profit, all three businesses grew well in the first half. Home credit grew very strongly indeed, more than doubling. And the reason was there was a reference to our attempt to buy Provident earlier this year. But prior to that, we'd already taken nearly 500 people in combination of agents and managers from that business. And so we've been able to grow very strongly over the last couple of years. And despite that business being very mature marketplace, we'd grown the loan book by over 40% over the last few years. So operating profit growing nicely in the first half. Looking forward, and we had our Q3 trading update a couple of weeks ago. And what we said at that trading update was that from a trading perspective, Everyday Loans, our branch-based lending business, going pretty well. Strong loan book growth, rates of delinquency or bad debts was in line with our expectations. Guarantor loans, the level of volume growth was a bit softer than we were expecting, but still strong year-on-year growth. And again, delinquency or bad debts in line. And home credit, the volumes were a bit lower than we were expecting, but the level of bad debts was much lower, and with the result that we were pretty happy with where that business was performing. And in our industry and in many others indeed, lots of people are talking about, well, when's the next recession going to come and what happens to these businesses? And we've been looking at that and very closely indeed. And the key thing for us is we don't know when the next recession is going to come, but we have had 8 years of reasonably steady, albeit pedestrian, you want to say it, in recent years, but we've still had growth. And if you look back over history, there aren't many periods when you see more than 10 years without a downturn. So we don't know when it's going to come, but we're getting ready for it. And what we've been doing to position ourselves ahead of that is high risk adjusted margins, which we've got in all three businesses. We've been, looking at tightening our scorecards so that, we can be more selective about the lending that we do. Having long-term funding in place, we've got debt facilities out to 2023, so we don't have to pay any of that back, which is good. And we've been looking to moderate our pace of growth. And the table you can see here is we have moderated our expectations for loan book growth. We think that's the right thing to do. And we've also increased our provisions because, look, we don't know. We're not seeing any signs of a downturn, but we're getting ready for it. And under IFRS 9 accounting, for those of you who follow that, and I'm looking at Mark here, we have to get ahead of that. And the standard is very clear that you need to look out. And if you think that something could have an impact and you've got a macroeconomic scenario, looking at the Bank of England stats and views on their scenario, then we want to just take a slightly more cautious view. And that's what we're doing, because we think that'll position us well for the next recession. So just in terms of outlook and how we look at things, we feel we're in a really strong place. We've got leadership positions in all three segments of our market, and that's capable of delivering good returns, return on asset and paying dividends. The market is a large and underserved segment of the population. It's one we know and understand very well. As I say, we've got leading positions in all three segments. We're highly focused on delivering returns for our investors. Since we did the IPO in 2015, we have grown incredibly quickly, doubling size in branch-based lending, more than doubling the size of our guarantor loans business, a 40% increase in our home credit business. And the focus very much now is, well, let's moderate our rate of growth and we can enhance the level of returns. As I say, we have long-term funding in place. We've got a 330 million of debt facilities provided by the credit funds and RBS, and the 285 of that's not repayable until 2023, and the bank facility is to 2022. So we're in good shape on that front. No change to our dividend policy. As I say, we're targeting a 50% payout ratio, and we're looking at a 3p full year dividend this year. We're currently trading at 26p, which according to Mark's recent research puts us on a dividend yield of about 11%, rising to about 15% in a couple of years' time. So I think that probably summarises it pretty well. So I would be happy to take any questions that you may have. Yeah. And I've got John O'Gillespie here as Deputy CFO as well, just in case there's a complex question I can't answer.
Obviously, the people you're lending to are more high risk. So what proportion of your people actually default, and how much of your time is taken up perhaps on litigation, trying to get your money back from those people, or do you just write off the bad debt and say, forget it?
Yeah, so it's a topic we discuss often as to whether we should go the legal route or not, and typically we haven't done too much of that, to be honest, and particularly when you've got loans very, very small size, you know, a £300, £400 loan, the cost of going to court would far outweigh that. Now, that's not to say we wouldn't, because sometimes it's important to make a stand so that, you know, you don't get sort of people taking advantage, if you like, and the word getting round, oh, they'll just let you off. So, you know, we do consider that, but we haven't been that aggressive on pursuing people through the courts, because it's in certain of our businesses it's just not worth doing. In terms of how much time we spend on it, I mean, the way that our businesses are organised is that the people who are writing the loans, they're responsible for collecting it. So it's quite self-selecting. So take our home credit business, for example, the agent is in the home and he's wondering whether, you know, well, if I write this loan, then, you know, my manager's going to be really pleased with me because I've written that loan and I've met my target for this month. But equally, they will be responsible for collecting that loan, and they only get paid when they collect. So they get a commission on their collections. So if they write a bad loan that's not going to collect, they don't get paid. So there's a real incentive there. In our branch-based lending business, similarly, we have targets for hitting volumes. But if a customer borrows and then 3 weeks down the road, their first payment bounces, the direct debit doesn't work, the branch is responsible for getting on the phone, getting hold of the customer, saying, what's happened, has something gone wrong? They are responsible for collecting. So there's a real incentive to lend well and to collect well.
So I mean, what proportion of your loans are bad debt?
So it varies depending upon which business we look at, because as you saw from the customer types, they're very different. So if you think of it in terms of as a proportion of the value of the loans issued, in branch-based lending, it's around 10%. In guarantor loans, it's around 6 or 7%. And in home credit, of course, it's much higher because A, they're very short-term loans and they're much smaller, but it's probably close between 40 and 50%. So people say to me, well, why don't you just lend to the good people? The trouble is, in order to find the good people, I need to lend to everybody. Yes, just behind you.
You've grown the branch-based lending business fairly aggressively. Is that mainly in the form of market share gains or lending to people who were previously not borrowers?
So if we look at, in branch-based lending, I mean, we are very, very discerning about who we lend to. If I tell you that last year we had 1.6 million applications and we lent to around 30,000 people. So for every 100 that come through the door, we're lending to about 3. So very, very selective in terms of, you know, really, really digging into the credit. Now, a lot of those applications will be duplicates or they don't meet our credit criteria. And the other thing that we do that really differentiates us from a lot of the online competitors is we meet the customer. And our philosophy on it is when you're lending directly to somebody in this space, something has gone wrong in their past, you need to find out what it was. And so when lending direct, in other words, when there's no guarantor present, you need to meet them. Now, whether that's in a home credit business where the agent gets to know the customer, goes up the garden path every week for 30, 40, 50 weeks, they know that customer incredibly well, they know what's going on. Similarly, in branch-based lending, We'll take the application online, we'll look at it, we'll score it. Yep, in principle, we're happy to do that. We then get them on the phone and then say, please come into the branch, and you're going to sit down with one of our managers for 45 minutes. And we're going to talk to you. We're going to find out what's happened in your life. Why are you coming to us? Let's go through your finances. Let's really understand why you need this loan. Is this loan going to help you? Is it going to solve your problem? Because if it isn't, we don't want to write the loan, because it's likely it's going to go wrong. You can only get that when you meet someone face to face. A lot of the online competitors in branch-based lending, so Likely Loans, 118 Money, you've seen advertised on television, they're all losing money. And the reason they lose money is because their operating costs are very low, because it's an online journey, they've got just some people in a call centre perhaps, or dealing purely online. We've got 73 branches, we've got 400 people out in branches, really expensive people, branch managers earning £60,000 a year, because they know they can dig into that credit and discern which people are the right people to lend to. And it's why our rates of delinquency, I mentioned 10%, that's incredibly low for a business like this. If you look at the online lenders, some of our competitors are at 50%. That's why we make money, they don't make money. And there's no one else doing it.
Don't quite get this guarantor loan thing. I mean, maybe I'm a cynic, but
Cynic is good.
I'm looking here that your interest rate's up to 80%.
Yep.
So if somebody asks me to guarantee a loan of 80% and I'm creditworthy,
Yep.
why don't I borrow from a bank at 4% and then lend them the money?
I get asked that question.
I got that wrong.
I get asked that question a lot. So first and foremost, the thing to realise is that the guarantors that are often acting for this customer or this applicant who is deeply subprime is not necessarily a prime borrower. So they might be equally subprime. Even if they were a prime borrower, why wouldn't they get the money and lend it to them? Well, because they don't want to. If they're uncle or aunt, even father, you don't want to be responsible for taking it on. Secondly, if they borrow the money, young Johnny doesn't improve his credit history. He has no credit file at the bureau. So actually, whilst yes, helping a short-term need, he or she at some point is going to have to try and get on the credit ladder. If they do it on their own, if they come to someone like a 118 Money or an Everyday Loans and want to borrow, they've got no credit history, then the lender will want to charge them a high-risk APR, probably much more than under the guarantor loans. You've got to remember that the guarantor rate that you saw there, and certainly at the lower end, it's lower than a credit union. Credit union is 42.6% APR. So when people talk about guarantor loans being high cost, it's not high cost, it's mid cost. It's the same as a credit union. In fact, some of our products are below that. So this is about...
The guarantor wouldn't be going to credit union.
No, but again, it's back to if you think, and a lot of families do provide credit to their other family members, but that runs out at some point. That runs out at some point, and it doesn't help the individual build a credit history. So this is all about getting a young person onto the credit ladder, their first loan at a much lower cost than if they were borrowing on their own. And we see it with lots of our customers. They borrow from us relatively small amounts. They maybe top up a bit later, and then they repay with a loan from NatWest. So that we get a cheque saying, thanks very much, we want to pay off the loan, and it's a loan from NatWest. So that person has gone from being a subprime customer and is now able to borrow prime. That's the product working. Now we're happy about that because there are plenty of other new customers coming out of university, coming out of college, young person, first job, got no credit history, needs to borrow. Yeah.
Can I ask a question about the FCA and the regulators, both a barrier to entry to you and somebody you have to deal with? What's the state of play with your businesses there? We've seen the FCA look at things like the pawnbrokers recently.
Yeah, no, it's a good question. So The FCA took control of consumer credit in April 2014, and it's fair to say before that it was managed by the OFT, and I think no one would be ashamed to say that it was a relatively light touch. The FCA is a completely different animal, and I think quite rightly they have seriously raised the standards. And in fact, it was one of the reasons we set up NSF in the first place, was because we felt that this transition to FCA, a lot of the companies, the operators, were not going to make it. And we're starting to see that, because the challenges of meeting all the regulatory requirements are difficult. And you're right, Keith, they are a major barrier to entry. In terms of where we're at now, because the FCA has been at this a while, we had a major high-cost credit review, so they did a really deep dive on all areas of our business, so in particular in home credit. And what we saw as the outcome of that was actually they had a really good look at it, and we spent lots of time with the FCA, lots of data, lots of meetings. They really understand what we're doing, and importantly, what we're not doing. This is an important service because for many people at this end of the spectrum, there are few sources of credit. There are few sources of credit because they don't have the infrastructure to be able to meet the customers, to really understand their needs, and to be able to collect the money back. So what we saw was some small changes to the operating models of companies in the space, but nothing material. So we feel we're in a good place in home credit. In branch-based lending, they're very comfortable with that product. We haven't seen any issues. They love the fact that we meet the customer face to face. A lot of the issues that they've been up against is, have you done affordability properly? Have you understood your customers' needs properly? We meet all of our customers. So in branch-based lending, we're in a good place. And then thirdly, Guarantor loans has grown very quickly. It's now £1 billion market from having started around a decade ago at zero. And so they have had a good look at that. And all of the dialogue we've had with the FCA about that is that, again, we think there may be some small operational tweaks, but we're not expecting any sort of policy pronouncements. And indeed, I was sitting with the head of policy at the FCA 2 weeks ago, and they said, well, because we asked them, where are you on Guarantor loans? And they said, it's not our issue, it's to do with supervision. So that tells us that this is something which is just looking at processes, procedures, but not expecting anything coming at us down the pipe from the FCA. So we feel we're in a good place. Yes, please.
Thanks.
Yeah.
Thanks so much for the presentation. I've just got the score sheets in front of me, and I was one of the questions is, was it clear how and when shareholders would see a return? And I just wonder whether you might comment on that a bit more.
Well, we're paying dividends now, and that was an ambition that my chief executive set very early on, that we would pay dividends. It's fair to say we have invested substantial sums in growing the businesses, as I said, very, very aggressively. We've more than doubled the branch-based lending business. We've more than doubled the Guarantor loans business, and we've grown the home credit business by 40%. And that home credit growth, of course, in a really mature market, and we capitalised on what was going on at Provident Financial, which, having taken 500 odd people from them, we decided we'd try and buy the business, and unfortunately we weren't successful in that endeavour. But so we have invested very heavily in building from nothing, a loan book of 336 million, and generating, and don't take my numbers, but Mark's numbers, 40 to 50 million of EBIT, from nothing. So we now need to prove the model. So I agree with you. We need to get that return on asset up to 20%. We're probably about there in home credit. We're not there yet in branch-based lending and Guarantor loans because we've been growing so quickly. But we can get there.